The NASDAQ 100 had its worst showing in 3 weeks on Thursday. But what if I told you that it still has room to run 11% higher? Hi, I'm Webster with FXStreet, and I'm about to tell you why that's the case. The NASDAQ 100 tracks the 100 largest non-financial companies listed on the NASDAQ stock exchange. Think Alphabet, Microsoft, Nvidia, and Amazon. It's tech-heavy, growth-oriented, and a barometer for what the market is thinking. The daily chart shows that the NDX hurdled up in the 4 sessions following last Thursday until this Thursday when it face-planted. The Federal Reserve cut interest rates by a 1/4 percentage point on Wednesday, but some profit-taking emerged after Fed Chair Jerome Powell demonstrated less appetite for a definitive cut in December. Here's the rub. After hours on Wednesday, the market presented us with the most important earnings day on the calendar through the end of the year. The problem being that while Alphabet surged on success in its cloud business, both Microsoft and Meta platforms shed weight despite decent results. U.S. Treasury yields have pounced higher in response to the Fed downplaying a December cut, giving investors more reason to move to safety. The other point is that the NDX was already trending close to the upper trend line that has led the current market rally since April's bullish reversal. That's why traders were already anticipating the NDX to pull back after nearing resistance circa 26,300. The general perception is that the short-term rally has given up in order to dash back towards support near 24,500. If we look at the gap up on the NDX between October 24th and Wednesday the 29th, the daily candles for the first 3 sessions this week moved well above the Bollinger Bands. This shows us that the price action was outside the normal 2 standard deviations away from the 20-day moving average, so it only makes sense that Thursday saw a reverse lower. But let's look at the longer-term chart. Here on the monthly, we see that the long-term resistance that began all the way back in 2019 peters out close to 29,000. This gives us an upside projection of a full 11% if we think the current AI rally still has legs. And that just might be the case. Although there are plenty of reasons to think we've already reached bubble proportions, the NDX has not given us a clear sign that this rally has reached its apex. Alphabet saw Google Cloud climb 34% year over year in Q3, while the market soured despite Microsoft Cloud's robust 26% growth. And analysts see $500 billion in Nvidia cloud revenue through the end of 2026. In other words, plenty of reasons exist to remain sanguine. However, it's good to account for any danger signs on the horizon. And here we have to look at breadth indicators. This chart shows us the percentage of NASDAQ 100 stocks trading above their 50-day simple moving average. While the percentage has moved lower in recent sessions in a short-term bearish sign, we can note that most rallies tend to peter out when 75% to 95% of NDX stocks are above their 50-day moving average. At the moment, we're below 60% in this indicator. This tells us that the 2025 rally in tech stocks has not likely reached its pinnacle, and we should remain invested for the moment. So there you have it. Expect the NASDAQ 100 to fold back to support over the next week or two, but then charge higher into the holidays before reaching a cyclical top around 29,000. If you found this helpful, please smash that like button, subscribe for more market insights, and drop a comment. Tell us where you think the NASDAQ 100 is headed next.